It's October 14, 2022, and the heart of London's Canary Wharf financial district is bustling with activity. Towering between the Citibank building and the HSBC building looms One Canada Square, a reminder of the grandeur of the global finance industry. For over a decade, loose monetary policy has been the status quo in response to the global financial crisis, often referred to as quantitative easing or Q. While beneficial for economies attempting to recover from the crisis, Q and other ultra-low interest rate policies have greatly distorted the bond markets and countless investments in assets that have grown significantly in value over the past decade, something that has not only caused significant financial strain to regional banks in the US, but has also made it difficult for central banks around the world to contain inflation. On this day, senior economic advisor Stephen King spoke to CNBC's Steve Sedgwick at the Ambrosetti Forum in Italy, and pointed out the downsides of prolonged periods of Q and low interest rates. King lamented that by nationalizing the bond markets and turning off the radar systems meant to detect inflation, central banks had been far too relaxed in allowing debt to accumulate. This, in turn, had created bubbles in various investments and assets throughout the global economy. In April of 2022, the US Federal Reserve began to hike interest rates in an attempt to curb the rapidly climbing inflation, but as King argued, their attempts had been too little, too late. He concluded that the recent financial turmoil, including the insolvency of several regional banks and the emergency rescue of Credit Suisse by UBS, was the consequence of a prolonged period of low rates and quantitative easing. What has resulted is a widespread concern about a potential recession and a series of warnings from experts to take precautions against being caught off guard. As long as the forces that drive inflation and financial turmoil remain unchecked, the global economy will continue to be in a precarious balancing act, leaving it to asset managers, banks, and other financial institutions to be more prudent when it comes to investments and debt. So, while we appreciate the benefits of quantitative easing and low interest rates to a troubled economy, it's crucial that we remember that the consequences of nationalized bond markets and overly relaxed debt accumulation policies can cause great financial strain and greatly increase the risk of a global recession. Thanks for watching.